Hey everyone, welcome back to The Explainer. Today we are completely tearing down the financials of Argan, trading under the ticker AGX. Now, if you've been watching the markets lately, you already know this company has been putting up some truly mind-bending performance numbers. But look, we aren't just going to sit here and stare at a stock chart. We're going straight under the hood. We're going to dig into the raw data and figure out the exact mechanics driving this massive wealth creation. Okay, let's dive into this. Here's our roadmap for the investigation. First, we'll look at the unbelievable stock run. Second, the growth engine. Third, we're auditing their financial health and margins. And finally, we'll tackle the valuation dilemma. Section 1. The unbelievable stock run. Setting up the crime scene. Just take a second. Let that number really sink in. 58,082.66%. That is Argan's 20-year return. I mean, we always talk about the power of compound interest in long-term holding, but this is the sheer magnitude of wealth creation when a company is literally firing on all cylinders for 2 solid decades. A tiny initial investment turns into an entirely life-changing portfolio. But here's the kicker. It's not just ancient history. It's happening right now. The momentum is just absolutely relentless across pretty much every time horizon. With the stock recently closing around $630, look at the year-to-date return, up over 101%. Over the trailing 12 months, a blistering 317%. And zoom out to 5 years, it's up over 1,300%. So, this isn't some meme stock that had one lucky pop. This is a compounding machine that just relentlessly climbs the mountain. Let's move into part 2, the growth engine. Time to look under the hood. Let's move to and see how this builds. Because eventually, stock prices have to rely on underlying fundamentals to support their trajectory, right? So let's look at Argan's net income compound annual growth rate. 5 years ago, they were growing net income at a really solid 41.9%. But notice how that steps up. Over the 3-year period, it jumps to almost 61% and holds super strong at over 61% in the trailing 12 months. Their profitability isn't just high, it's actively accelerating. They are speeding up, not slowing down. And man, when we dig deeper into the actual cash and earnings, the story just gets even clearer. Revenue over the last 3 years compounded at 27.5%. Fantastic top-line growth. But watch what happens when that money flows through the business down to the bottom line. Earnings per share over the trailing 12 months, compounding at 56.3%. And the absolute standout metric here is free cash flow. Free cash flow over the trailing 12 months exploded by over 155%. This immense flood of actual spendable cash, that's the high-octane fuel for this historic run. All right, part 3, financial health and margins. Let's check the chassis. Now, generating massive piles of cash is great, but how stable is the actual foundation holding it all together? Well, so the crucial point is zero. Yep, absolute zero. Argan achieved all of this accelerating triple-digit cash flow growth with a debt-to-equity ratio of 0. They aren't borrowing a dime to manufacture these returns. There's no massive debt load hanging over their heads waiting to crush them if interest rates shift or the economy slows down. They are funding this whole explosive operation entirely organically. So without debt eating away at them, the rest of the balance sheet looks incredibly healthy. A current ratio of 1.59 shows us they have more than enough immediate cash to cover short-term liabilities. But the true hallmarks of a top-tier business, they're in those next 2 numbers. A return on invested capital of 21.6% proves management is elite at turning capital into profit. You combine that with a return on equity of nearly 30%, which measures how efficiently they use shareholder money, and you've got a total capital allocation machine. Plus, they're actually getting more efficient as they scale up. Their net profit margin currently sits at 12.24%. And what's really vital to note here is that this is a significant expansion compared to their 3-year average, which was only about 8.8%. Margin expansion is basically the holy grail of investing. It means for every new dollar of revenue that comes through the door, they are keeping a larger and larger percentage of it as pure profit. It acts as a massive multiplier on top of their growth. Which brings us to the climax, part 4, the valuation dilemma. Basically, is it too late? Now, what's really interesting about this slide is the extreme tension between the past and the future. Because the obvious question everyone asks when they see a stock over 100% year-to-date is, did I totally miss the boat? Argan's trailing price-to-earnings ratio, based purely on the past, sits at a lofty 64.75. A lot of value investors see that and immediately think, whoa, absurdly expensive. But then look at the forward PE, which projects future earnings. It drops all the way down to just 16.61. This massive disconnect means the market fully expects their earnings to catch up to the stock price, and fast. And we can mathematically check if that initial sky-high PE is justified by looking at the PEG ratio. This factors in the company's growth rate. Argan's PEG ratio is exactly 1.09. In the investing world, a PEG ratio right around 1 indicates that a stock is fairly valued relative to its explosive growth. So, neutrally speaking, despite a backward-looking multiple that seems completely nuts, this specific metric suggests their historic cash flow and earnings effectively justify that high price tag. Think of it like buying an expensive car, but finding out it comes with a Formula One engine. But wait, it actually gets even more interesting. When we run a discounted cash flow, or DCF analysis, which is pretty much the gold standard for estimating the true intrinsic value of a company based solely on future cash generation, we get a fair value of $1,221.69. Think about that for a second. The stock is currently trading around $630, yet the pure cash flow math dictates its fundamental worth is well over $1,000 a share.
And this brilliantly illustrates a massive 48.38% margin of safety. I mean, that completely reframes our entire valuation dilemma, doesn't it? It implies that even at today's seemingly high price, you're buying the stock at a steep mathematical discount to the future cash it's projected to generate. Finding a company with crazy momentum that still offers a structural buffer like that, that is a truly fascinating scenario. So we're kind of left with this striking paradox. You've got a stock that has gone on a historic 58,000% 20-year run. It carries a scary-looking trailing 64 PE ratio. Yet it operates with absolute zero debt, it's actively expanding its profit margins, and it presents a nearly 50% margin of safety based on discounted cash flows. It's literally the ultimate value and growth puzzle. So I'll leave you with this to ponder. Does a setup like this actually fit into your own investing framework? How do you personally reconcile rapid price appreciation with deep intrinsic value? I really hope this explainer gave you the data you need to answer that for yourself. Keep learning, keep analyzing, and I'll catch you on the next one.